Hi, this is Kayla Harris, Marketing Manager at Aprio. Thank you for joining us today for this webinar on the impact of the 20% pass-through deduction on professional services firms. I want to take this time to first introduce you to our two speakers today. We have Bob Greenberger and Scott Goldring. Before I get started, I wanted to share with you some housekeeping notes. To receive CPE credit for this webinar, you must answer 3 polling questions, one at the beginning, one in the middle, and one at the end. If you have any questions during the webinar, please submit them through the question dashboard and we will answer them throughout the presentation. Now, let's get started.
So good afternoon, this is Scott Goldring, and thank you for joining us today. And as we begin our presentation, our objective today is to help all of you be knowledgeable enough not to become an expert, but knowledgeable enough to be able to discuss with your tax advisor this new deduction. Please ask questions. We may not get to them immediately, but we will answer all questions or contact you afterward if needed. So let's get started with Public Law 115-97, nicknamed the Tax Cut and Jobs Act. It fulfilled 2 of President Trump's key campaign pledges: to lower income taxes paid and to make U.S. corporate income tax law more equitable with other countries. Several other countries that had significantly lowered their income tax rates for corporations had seen significant investment, and we want more of that investment in our country. It is a temporary deduction for 8 years due to some arcane Senate laws about passing tax laws that don't pay for themselves immediately. So the Tax Cut and Jobs Act, again, the first thing it did was lower C corporations' income tax rates. Before this, C corporations were taxed at levels. The first few thousand at 15% income tax, then 25%, and then 34% and 35%. So it was still a little bit lower than the old top individual rate of 39.6%. The new flat rate for C corporations starting 2018 is 21% on all income. Now the new tax rate on individuals is 37%. That's a rather large disparity. And the huge disparity, Congress didn't want a decision on entity choice, C Corp versus S Corp or partnership, to be overly influenced by the tax rate. So they came up with this Section 199A, qualified business income, to partially equalize, so it become less of an incentive to change. Now, I recall an old story where an associate at J.P. Morgan in his early days of the bank walked up to him and said, Sir, what will the stock market do? And he said, it will fluctuate. And similarly, I can see a young associate at a CPA firm walking up to a senior partner and saying, Sir, there's a new tax law coming out. And the senior partner will say, yes, it will be more complicated. As you know, Congress, they can't exactly make things simpler, so they added in various limitations, investment objectives. It is complicated, although it's a simple concept. We plan to achieve the goal of you understanding this well enough to be able to discuss this with your tax advisor.
And Scott, I'll just add that that prior to this, the 1986 Act, which is 3 decades ago, was probably the most comprehensive and most complicated tax act. And this one, I think, trumps that, no pun intended, that it's clearly not tax simplification. 199A, as complicated as it is, there's some other areas of the new tax law that we won't get into today, but it's definitely much more complicated than things were a year ago.
And if I recall from that 1986 tax law changes, it took a couple years or a little more for the IRS to really catch up to all of that, the changes. And it will certainly be different now. We know this past August, they came out with some regulations that help define a lot of the things that were unclear in the tax law. And those regulations are considered to be the law until they come out with something more permanent. So we do understand a lot more, but there are still some smaller questions that will go into the future for perhaps another year or two. So how 199A qualified business income works. It allows up to 20% deduction of ordinary income from each pass-through business. Now we're going to see this year somehow, which we don't know yet because we haven't seen it yet, on the Form 1040, a new line. After itemized deductions for this new deduction called qualified business income, QBI. Back to the first line on this slide, some different definitions. For example, pass-through businesses. Well, that includes S-corps, partnerships, and proprietorships taxed as Schedule C, Schedule E, or Schedule F. The ordinary income. That is where net income of a business breaks out between all the ordinary income of the operations of the business and some of the tangential matters. For those of you who are partners or owners of an S-corp or partnership, when you get your K-1, you may notice some other lines besides ordinary income, like interest income, dividend income, charitable deduction expense. Those areas get separated out and get treated separately on your individual tax return, and they do not apply, as they're not ordinary income, for this deduction. Finally, up to 20% at the beginning, that's important because up to, well, there's various limitations that we're going to go into in just a moment, that many individuals will not achieve that full 20% deduction. Finally, this is not applicable for Georgia income taxes, and probably most other states, although we haven't investigated every single state.
Scott, I just had a question come in because you mentioned S-corps and partnerships, and the question is, how about LLCs?
Sure. Well, LLCs are a legal entity, but for tax purposes, income tax purposes, they are considered either a C corp, an S corp, a partnership, or proprietorship. So it's not the LLC that becomes important, is what is the business and how is it taxed. If it's taxed as a C corp, then this wouldn't apply. They already get that preferential rate. If it's taxed as one of these other entities, then they would absolutely be the potential there for ordinary income to get this deduction.
Thanks, Scott. And for those of you listening to the webinar, kind of the easy way to remember will be what Section 199A, the actual code says, who it applies to, and it basically says everyone in the world who is not a C corp. So if you're not a C corp, and you saw on that slide here that it's a proprietorship taxed on Schedule C, or rental property on Schedule E, or a farm on Schedule F, pretty much everything in the world that's not taxed as a C corp might be able to get this QBID 20% deduction.
Let's skip to the next slide. So 199A, limiting factors. We have said up to 20%. Well, how do you actually tell how much of a deduction it might be? So the below factors lead to 5 potential situations. And those situations we'll talk about in a couple minutes. But these are all the factors that are going to have an impact. First of all, the industry. The law, the Tax Cut Jobs Act law specifically referred to specified service, trades, and business that are to be treated differently. And the IRS regulations introduced in August of 2018 better defined what many of those specified businesses are. In addition, taxable income on Form 1040. This is a little bit different than most other deductions we've seen in the past that are often based on, for example, your adjusted gross income. This is based on the taxable income, and we'll look at some examples of that, including other tax-advantaged income. And the most common look at tax-advantaged income is your qualified dividends and long-term capital gains that already get a lower rate. And so those may be a limiting factor if they're really, really high. For example, if you sell a business or a building in a year, and there's a lot of long-term capital gain, then those could limit somewhat the deduction from this. Wages paid could be a limiting factor. We'll take a better look at that. Property owned within the business. And these two limitations, the wages and the property, you do get to choose whichever one is more favorable to you. And we'll see that in a moment. And then there are, for people who own multiple businesses, there are two different sets of options. One option is aggregation. So for example, a real estate business where all the management and wages are paid out of one company, and then there are separate companies to own all the property and collect all the rents. So it may be beneficial for the taxpayer to aggregate these businesses, consider them together, and that's an optional item. Once it is elected, you stick with it. You can't just change it every year. On the other hand, there are some related businesses that are required to be grouped together, and this is because they may be separate companies, but it's really one business. And we'll take a couple look at those examples. And now let's go to the first polling question.
As you can see on the screen, we're sharing the results with you of the poll. It shows that most people chose interest expense.
Which is the correct answer. It is not a limiting factor for 199A deduction.
And we'll get into some more details. Scott's going to go through some examples on how wages might limit the deduction and how property might limit the deduction. We did get another question, and for those of you that want to continue to ask them, we'll try to get to all of them. But Scott had mentioned a couple slides ago that Georgia does not follow this law, which means that the QBI deduction that you get on your federal tax return is going to be an add back on your Georgia tax return. Why not? I don't know. That's a good question. I don't know why not, but because there's essentially a windfall to all the states, including Georgia. There's a windfall because a lot of deductions were lost, such as state income taxes and real estate taxes and miscellaneous itemized deductions. Alimony starting next year is not deductible. So there's a lot of deductions that were lost, and a lot of people would owe more money, but the federal government decided to reduce the top marginal rate from 39.6% to 37% to kind of offset that negative impact. States that opted not to reduce their tax rates would have gotten a windfall, and so some states opted to go ahead and reduce their rates. So the good news is Georgia did that. The governor signed into law earlier this year reduction of the 6% Georgia rate down to 5.75, and so that'll hopefully offset the QBI deduction and other deductions that you lose. Starting next year, 2019, the rate goes down to 5.5%. And there's a lot of other changes in the new law that Georgia, for the most part, followed, and a handful that they did not follow, but that's kind of out of the scope of this session here, and we'll get back to 199A.
And I will just before we continue again, as Bob was saying, many deductions were lost, but by and large, we've seen from the projections we've already done for many of our clients that we do every year, we have seen that for many people, if their income is approximately the same, the taxable income may increase a little bit because they lose some of those deductions, but with the rate being lower, the income taxes paid will still be less. And we've even seen where for some clients, their income is up a little bit and then they lose deductions, so income's even higher, but they still pay less in income taxes because of the drop in rate. So that certainly helps achieve one of the objectives from this law. So as we continue, we said that there's 5 situations that every taxpayer can look at. And the first one is when taxable income is below either $315,000 for married filing joint or $157,500 for other filers. If you're in this situation, then Your QBI deduction will be 20% of your business income, with one small exception I'll mention in a moment. So for example, if you have $200,000 of wages and $100,000 of business income, that $100,000 of business income, because you're married and you're below that threshold, that $100,000 will result in a $20,000 deduction before you figure out your taxable income. The only other limit to that would be if all your income is qualified dividends or long-term capital gains, then because those are already advantaged income paying lower rates, they would limit you perhaps not being able to take the full 20%. That's probably a rather unusual circumstance, but it certainly could happen at some times. And so that would be the only limitation to that. And now, when we get beyond that income level is when some of the other limitations start to come around. So let's take a look now. We had mentioned before, there's a wages limitation. And that wages limitation, it starts getting phased in when you pass that taxable income threshold of either $315,000 for married filing joints or $157,500 for other filers. So 50% of allocatable wages get compared to what the QBI deduction might be, and then the lower one applies. Now, it's only wages. So, for example, something that will not be included, partnership guaranteed payments. In some ways, they are similar to wages, but they are not wages, and the law specifically says only wages apply. Proprietorship, self-employed income, is very similar to, in this case, to partnership guarantee payments. But if you have a Schedule C and you have income from your business, then any income you earn personally are not considered wages, where wages you pay out to others, and the same thing in a partnership. Wages paid out to other employees, those count, but not for the owners. Contract labor also does not qualify. We don't know why Congress made this distinction, but it is clear that that's what the law says. And so as an example, if you do have a proprietorship where you earn $1 million from that proprietorship, if you use all contract labor, then there's no wages, so that might limit, because your wages are essentially zero for the purpose of this deduction. Where if you do have other employees, then those wages would allow further deduction. Finally, I want to go back to that word allocated. We said 50% of allocable wages apply, and that comes if you're the owner of an S Corp or partnership. The same way income flows to you, whether you're a 1% owner, 5%, 10%, or even 100%, that same percentage of wages within the business would also be allocated to you and be used for this limitation. Separately, we have the property limitation. And again, start phases in at exactly the same income levels, over $315,000 for married filing joints. Property is depreciable property at its original cost basis, with a couple of exceptions. So for long life property, such as buildings, the original cost basis is the property value used for all the years while you're depreciating it. If a commercial building is 39 years, residential rental is 27.5 years. Other kinds of equipment might be 15 years, 7 years, 5 years of the official life of the asset. If it's less than 10 years, then you use it for 10 years. So if you all buy a bunch of computers for a couple $1,000s each, then you may even take full depreciation in the first year, but that couple $1,000s counts as part of this property limitation for 10 years. We have seen that computers and furniture may often be too small to make a real impact. The intention is, again, back for investment of equipment in factories and other larger industrial applications, as well as for buildings themselves. Because it's only 2.5% of the property plus 25% of wages that are this limiting factor. So you figure out what the limit might be by this equation. You compare that to what the limit might be by the other 50% of wages equation, and whichever helps you more, that is the one that applies. And let's take another polling question. And so the question was, the property limitation has maximum impact for taxable income under 100,000, and the answer is false. And the reason is because when the taxable income is under 315,000, then limitations are not needed or not used, not applied.
Before we go to the next slide, there's a few people that are controllers or CFOs and are worried about this slide where it says that the property is less than 10 years, and you're keeping track of depreciation 2 or 3 different ways already: federal purposes, maybe book purposes and tax purposes, maybe Georgia differently. Does that mean that you're going to have to keep track of the basis in another depreciation system? Yes, it does. So just wanted to forewarn you that you'll have to get all of that ready before your books are audited and your tax returns are done, because there's going to be a whole different depreciation schedule for all of your assets for QBI purposes that's different than Georgia, different for IRS.
Although it will be a different schedule, but it will be the same assets. The original cost basis will be the same. The difference will be that once is the age of it, that these assets will age out. So after 10 years for computers and furniture, they no longer apply, even though they may still be useful in your office. And the same thing with a building.
So Scott's making it sound easy. Call Scott. I'll give you his home phone number at the end of the session. No, it'll be somewhat more complicated.
And during the first year will be the hardest, because after the first year, if you have it set up properly, it should get a little simpler.
That's true. And I'm not going to give you his home phone number.
But good question. Actually, I don't have a home phone number anymore. Who does anymore? But as we go back to the slides, so the next 2 situations, we said there's 5 altogether, are fairly similar at their income level. Taxable income between $315,000 and $415,000, or for other filers, half of those amounts, $157,500 and $207,500. Now, in this interim threshold, the QBI deduction is tested for wages and property, but they don't have their full impact. So, for example, at exactly $315,000, they have 0 impact. At exactly $415,000, they have 100% impact if they're limit at all. And for example, $340,000 on the slide there, for those who do the math really quickly, that's exactly 25% of the way between $315,000 and $415,000. So if wages and or property limit the deduction, then 25% of the limitation would take impact. That may be a little bit confusing to listen to, and I apologize for that. It's rather straightforward when you actually go to do the math at the end of it of how that limitation would work.
So in this case, Scott, if I'm right, it's 340,000 minus 315,
right?
Is 25,000,
right?
Divided by
the 100
spread between 315 and 415. So the easy way to figure that out would just be the taxable income before the QBI deduction, which in this case is, the example is 340,000 minus 315 is 25%. So I'm getting a 25% haircut.
Yes, if wages and property limited at all. Often I think we're going to see, and we're certainly going to plan with our clients, that let's make sure that wages are not a limitation if this deduction is important. And property will be a little more what it is. You're not going to go out and buy a building just to try to take advantage of this deduction.
Right.
Now, the specified service trades and businesses, as the income approaches the higher end of this range, the total QBI deduction is going to approach zero. But let's remember, if your income is in this level, then every business gets looked at independently. And what we know about many of our clients is, as they start to have higher income, they have other investments. They own real estate, they own pieces of other companies. Each of these investments would be calculated individually. Some would be limited by SSTB, the Specified Service Trades and Business, and some would not. The rules within this range would be the same.
And there's some of you listening that are with physician groups, that are doctors, and are attorneys with law firms, which we'll get into a little bit more detail, but both of these are those tainted businesses called SSTBs, or Specified Service Trades and Businesses. And so if you are a specified service trade or business and you're in this slide we're looking at now, between 315 and 415,000, you're actually going to have two haircuts. One, possibly you're going to have to look at whether or not your wages and property are reduced, and then a second on top of that for an SSTB. So it gets a little bit complicated, but just remember there's two haircuts.
Yeah, and the concept is going to be the same, that for as the income goes higher, the SSTB, Specified Service Trades and Business, gets less of a deduction. And we look at the last two situations, and again, there's two situations here. Even though taxable income is above 415, the SSTB is limited to zero. So QBI for all other businesses gets tested individually unless there's some kind of aggregation elected, like we spoke of earlier, some kind of grouping of businesses. In that case, those businesses would be blocked together and evaluated as one. And so an article I wrote recently on this, we look at some examples, and so I just thought I'd read out quickly from that. And so this example is for a boutique law firm, and this is one of the real complications of this new law. This boutique law firm, there's a junior partner who's a 10% owner, there's a mid-level who's 20%, and then the founder of the company is a 70% owner. Since it's a law firm, it is a specified service trade or business. And if there's $2 million of income, taxable ordinary income inside the company, then that first junior partner, he has $200,000 of earnings. He's going to be treated back like we saw back in situation one, because that's where his taxable income is. Where the second guy, 20% owner, 20% of $200,000 is $400,000 of income, and he's going to be treated like the last situation we saw, between 315 and 415, once he gets either his itemized deductions or standard deduction. Where the senior partner, she is 70%, so 70% of $2 million is $1.4 million of income. They're not going to get any deduction from this deduction for their main business, but at that kind of income, they probably have other investments, and so those other investments will have to be looked at individually. And then the one side note to that is also, if you look at that, they're all different for their taxable income. Therefore, what decision is the right decision at the company level? And we're going to look later on at some planning opportunities. And one of the real challenges of planning opportunity will be like in this example I just laid out, where the different owners are very different situations, and what benefit one doesn't benefit the other, and therefore maybe it is or maybe it's not worthwhile to pursue.
And Scott, that's a good point. The difficulty of the 199A is that someone that gets the same deduction 2 years in a row, it might be treated much differently each of those 2 years on their own tax returns. And someone that gets the same deduction that has the same ownership in a business as someone else in the same year might have it treated very differently, because, for example, one person might be below $315,000 and they don't care if it's a SSTB law firm or physician group, because they'll get the full deduction, and the other person might care. So there is not a rule of thumb on any of the 199A you'll find that fits everyone.
Yeah, it will be a lot of planning discussion about what is best overall for the firm and the different owners. And then separately, of course, since we brought up planning, I'll just take a quick interlude and just say also, let's remember that all this is based on the taxable income. Well, when we're doing tax planning for our clients now and next month and into December, we don't yet know what their taxable income is going to be. In the past, we would always look at what's your marginal tax rate, and the marginal tax rate might differ a little bit. It might be 33% versus 28%. But in this case, you might be either in or out based on other activity that is harder to plan for, charitable deductions and some other income of a spouse, and there's a lot more variability. So planning will become more challenging for this deduction. So let's go on to reporting and calculation. So we've seen the 5 scenarios, and we will just touch up on them briefly again later. But everyone's going to fit into one of those situations. But reporting, how do you get all this together? Well, again, we already said each business is calculated separately. If 20 different businesses, then perhaps 20 different calculations. If 5 of them are all related and they choose to be aggregated, then those 5 will kind of become one calculation. For businesses with K1s, wages and property get allocated per ownership percentage and get reported on the K1. For other businesses, they don't get allocated. If it's a Schedule C or Schedule E, that person will get 100% of it, but you still need to be able to get at it. Bob mentioned before the example that someone had asked about of fixed asset schedules, the depreciation schedules for all the property. That will take some work to get to. Another question, and we have not yet seen what it's going to look like on the tax return or on the K1. We just don't yet know, the IRS doesn't know exactly what the forms will look like. Another question is, what if business has a taxable loss in a year? How much does that get considered? And so one of 2 things can happen. Either it gets thrown against other businesses that have positive income, or that taxable loss carries forward separate from any kind of net operating loss or separate from other tax attributes just by itself, and it gets considered in next year. So for example, this year the business has a $50,000 loss allocated to that individual. Next year that individual has $70,000 from that business. $70,000 is not the applicable number to use for QBI for that second year. 20,000 is 70 minus 50. That $50,000 loss has to carry forward if it doesn't get used otherwise. And finally, again, we mentioned before briefly the impact of qualified dividends and long-term capital gains. Because they're already a preferential rate, 20% over $450,000 of income, or 15% between about $150 and $450, both for married filing joints. Those already have a preferential rate, so they may impact the amount of QBI deduction to be taken.
Scott, hey, back on the comment about your loss. Interesting thing that came out about that. So in Scott's example, he said there's a $50,000 loss this year, so there's no QBI deduction. Next year they have a $70,000 worth of income, and so the QBI deduction is not 70,000 times 20%. You have to subtract the 50,000 and take 20,000 times 20%. Let's suppose that this particular individual had taxable income over 315,000 or over 415,000, then they're going to be limited unless they have wages. Well, what if they don't have any wages next year? In that year that they have $70,000, they won't get to deduct any. And so there's a little lack of clarification that the AICPA actually reached out to the IRS back in February and said, if there's going to be a loss being carried forward, shouldn't we also carry forward, let's say in the year that there was $50,000 of loss, if there was a lot of wages that year and there weren't the next year, shouldn't those wages be considered and carried forward to the next year? So there are some, although the IRS issued proposed regs on August 8th, 184 pages. There's probably a lot more to come and a lot more issues that haven't been clarified. That's one of them that that Scott just touched on. There is a draft, by the way, of the that it's not final yet, but there is a draft that's come out that the IRS has released on how the K-1s will look. But as you can imagine, it'll have to be a separate line that's going to have the Section 199A income. It's going to have your allocable share of the wages. It's going to have your allocable share of the unadjusted basis of the assets. And there'll be a couple more lines in there for REIT dividends and PTP income as well.
Again, more complex.
That's right.
Let's go back, and now let's go over to our third polling question. And then in a moment, we're going to take a look at a couple of questions more questions that come in to answer them at the end of the question. And so thank you for all who replied. And the question was, which of the following is most correct regarding QBI reporting for 2018? And the answer, like almost everyone got, is yes, partnership and S-corp preparation of tax returns may be more complicated due to the need to report wages and property. Thank you all for those polling questions. And now let's look at one or two more questions.
There's a question that was asked that says, does 2017 loss have an impact on the 2018 20% deduction? And the answer is, it does have an impact. But there's different types of losses. So take, for example, a passive loss carry forward from 2017, when QBI deduction didn't exist, to 2018, the passive loss carry forward will reduce potentially your taxable income because it might offset passive income in the following year, but it's not going to hurt you and it's not going to reduce the QBI deduction. Unlike what Scott mentioned earlier, if you have a loss in 18 when the law is in effect carried forward to 19, the loss that you have this year, that not only do you not get a QBI deduction, but it hurts you in the future. The second question that was asked as a prelude to what we're getting ready to get into was, you've mentioned several examples of SSTP professions. What are the non-SSTP professions? Which is a perfect entree to the next section we'll get into. And so we can go ahead and get into SSTB, or specified trade or businesses. So there's kind of the list of the bad, tainted industries to be in. Accountants like Scott and I, and the legal community and medical community, that's half of our listeners out there. And so that's kind of the list, but there was a lot of questions about that, and what does law really mean, and what does accounting mean? And so the 184 pages of proposed regulations that came out a couple months ago clarified a lot of that. We won't get into the full 184 pages, but there are specific things, for example, on law firms, actuarial sciences, performing arts, consulting, the proposed regs addressed as well. But you'll see that at the end of that first bullet, there's this half a sentence that says, where the principal asset is the reputation or skill of the employees or owners. And so what they're trying to avoid is to allow someone who's running their own business as if they were a W-2 employee, because we know W-2 person doesn't qualify for a QBI deduction. So they're trying to get around that type of situation. That was considered a very broad term. Everyone was concerned about how that might be defined by the IRS. And actually, it was good news with the proposed regs that they defined that last part, the reputation or skill of employees and owners. They actually came out with 3 specific examples in the proposed regs. So there is some clarity there. The ones that that will be treated, that fall victim to this catch-all phrase, is people that are endorsing products. So if you have a trade or business in which a person gets fees or compensation or other income for endorsing products, then that is an SSTB, or a tainted business, that might not be eligible for the QBI deduction. The second situation is a trade or business in which a person actually licenses or receives fees or other income for use of their image or likeness or name or signature or their voice, for example, or trademark. And then the third was kind of appearance fees. So if you're getting fees or compensation or income for appearing at an event or on the radio or television, that would not qualify. Those three very specific examples that should make everyone else happy still raise a lot of questions. For example, if you've got a famous person that opens 4 restaurants, well, the restaurants are trade or businesses, and they clearly qualify for the QBI deduction. But if he's also doing some appearances or endorsements on a separate company, then that endorsement income does not qualify for the QBI deduction. The odd thing is that everyone's going to his restaurant because he's a famous guy, and they're using his name. Ted's Montana Grill, I guess. Maybe they're going there because of Ted Turner. I don't know. But if Ted is using his name for other purposes, for endorsements, that wouldn't qualify. But the fact he's using his name for his restaurant is okay. So there's still some issues with that, even though there was some clarification in the proposed regs.
A lot of clarification. We all feel a lot better for most of our clients.
We do. They also added in 199A, that second bullet there that says investing, investment management, and related businesses are also specified service trade or businesses. And what the proposed regs got into, the third bullet there, is it talks about a business directly related to another business that's considered an SSTB. So I can't tell you how many physicians and attorneys came to me and said, you know, we've got our building, and why don't we just get a bunch of rental income from our building? And we'll separate that out because rental income qualifies for the qualified business income deduction, even though our physician practice or law practice doesn't. Well, you're right, but the proposed regs came out with a kind of a fine line rule that says if you own more than 50% of that building, and if the revenues are more than 80%, so in other words, if the law firm owns the whole building and 100% of all the gross receipts are related to the law firm that is an SSTB, then they're not going to allow the rental income to be able to get the QBI deduction. Let's say that you dropped below this 80% threshold and then you're only getting 70% of the income. That's fine. It's not automatically all considered an SSTB, but 70% of it is tainted and 70% of it would not qualify for the qualified business income deduction. Let's think about that other factor though. I said 80% of the income has to be attributable to an SSTB if you own more than 50%. So if a law firm and a CPA firm own a building, they each own 50% of it and they get all the rent, it's not going to qualify. Well, what if we got a 2% owner in there that isn't a law firm and isn't the CPA firm, and now the CPA firm only owns 49% of it and not 50% of it? That seems to work for now until final regulations are issued, but that certainly would work in that case.
And I think it really comes back to, is it one business just kind of pushed into 2 different companies, or really they separate businesses? So if a law firm buys a 100,000 square foot building and it rents out 3,000 square feet to itself, well, that's clearly a separate business to own the building. Where if it rents out the whole thing to itself, it's the same business, just separated to different companies. So there'll be a lot more discussion of specific situations, and in many cases, it will be, situation by situation.
Before we get off of SSTBs, just a couple other quick things because we'll be running out of time anyway. In the proposed regs, there was what they call some de minimis exceptions, that if you have a trade or business that has less than $25 million of gross receipts, you're not going to be considered an SSTB, specified service, trade or business, if less than 10% of those gross receipts are from a disqualified field. That threshold, the 25 million, if you're more than $25 million of gross receipts, that 10% is then replaced by 5%. So essentially, if you're not an SSTB and less than 10% applies and you're below 25 million, then you are A-OK.
And that's really a lot of what we see from the specified service trades and businesses. If your situation doesn't fit one that we discussed, then certainly reach out to us. We want to talk a little about planning, and then I saw there was at least one more question that just came in a few minutes ago, but some planning ideas. So the one fairly simple thing we spoke about a few slides ago was wages. Are the wages high enough? And this is especially applicable for a very small company, an S Corp, where the owners, in past times, they might have said, I'm going to earn $500,000 for the business. I'll only take $50,000 of wages and $450,000 of business S Corp income distributions, and that way I'll only pay payroll taxes on $50,000. Well, that's correct. But if you had taken higher wages, then it is likely that the QBI deduction will be far greater than the payroll taxes to pay for those wages. In addition, if you are taking those low wages, that really limits retirement plan contributions. And so that is another key point to taking low wages. There are some optimal numbers in there that we can look at. The biggest question, perhaps, is that first one up there of C corporation versus S corporation. In many situations, it's not going to make sense. In some, it may. The two primary considerations there off the top of my head are A, do most, if not all, of the owners have a very high income, well over that $415,000 taxable, and B, is the need for cash not urgent enough where you're not going to take all the money out every year? Let me throw the example out there. A 3-owner S corporation for plastic surgeons that the business earns $5 million a year. And so each of those 3 owners can take some wages and the rest as other income. To be a C corporation and pay out $1 million a year each in salaries and take the remaining $2 million and pay all that out in dividends that year, that doesn't make any sense. On the other hand, if that $1 million apiece is enough for those 3 owners to live off of and live well off of, and that other $2 million can stay inside the C Corp, now you will pay 21% income tax, and the dividends on the other $2 million, well, you're not taking it out right now. So you're not going to pay those dividends now. Otherwise, that dividend rate would make it somewhat prohibitive. Well, let that other $2 million grow. It gets taxed inside the C corporation rather than taxed personally. Years later, so you now gain some value from the time value of money. Years later, you take it out as dividends, and if you're now in a lower income tax bracket, maybe you no longer work in the practice, no longer get salary, then those dividends may get taxed at a lower rate. So you get benefit from both time value of money and in the future getting taxed at a lower rate, where if you're going to take it all out in that first year, then you really lose any income tax benefit. Lastly, there are 2 changes there's 2 income expense items that don't actually get decided during the calendar year. As you all know, all the revenue and all the expenses through December 31st become taxable for 2018. But those two other items to give some extra thought to are, one, depreciation. You can make some options later of taking ordinary depreciation, taking accelerated for perhaps bonus depreciation, taking Section 179. You can make those decisions when you file the tax return. And therefore, there may be great benefit in looking at it later and saying, it's better to take all Section 179 this year, or it's better to take none of Section 179 this year, and to use that decision for best benefit.
So Scott, I guess for example, if someone's at $415,000 of taxable income and their QBI deduction's zero because they're an attorney, but if they take some accelerated depreciation and it takes their taxable income down to say $310,000, which is below $315,000, they get the full QBI deduction then.
Exactly.
Okay.
And somewhat similar to depreciation is retirement plan contributions. So there's often some leeway of how much do you want to contribute to the retirement plan. Well, extra retirement plan contribution, even though it's paid for after the year, counts as an expense. So you may pay it in June of 2019 for 2018. That extra expense can lower you into a different bracket where you can take significant deduction. And so that's worthwhile to consider because those two items, again, are after the year. Someone else also a few minutes ago had a question about depreciation. Bonus depreciation is considered ordinary income, so it would absolutely be included in the QBI. Section 179 depreciation, it is a separate line on the K1, but it is, but we actually have to look it up again to make sure we remember correctly how that is treated as to whether it would definitely.
I think it would reduce the taxable income and therefore and reduce QBI. So I think
it'll be help you for QBI. You mean?
Well, it would reduce qualified business income because there'd be more depreciation. So the QBI should be lower, and the taxable income would be lower. I think is that correct?
And I that's what I recall, but I didn't look it up specifically beforehand. And these are new laws and new regulations. So, for example, I think if you take 100% bonus depreciation or 100% Section 179, those two things would have the same exact impact on QBI. But we want to confirm that. We are almost out of time. We should do one last check to see if there's any more questions. And certainly afterwards, you have our email and phone numbers at the end. And so certainly contact us if we can be of more assistance. And in addition, there is this complimentary consultation as you have questions. So let's just check one more time for any more questions.
We had all of them.
We did answer the questions, and I hope we achieved our objective of helping you understand enough of the basics where you can have a better conversation with your tax advisor. And we know there'll be more questions, and certainly we don't yet have all the regulations, but we appreciate you all joining us, and we hope this has been helpful to you. And one more question came out. Can you read that aloud, Bob?
There's a question about a partner at an engineering firm, which, by the way, engineering firms were specifically written into the law, along with architects, to not be considered specified service trade or businesses. So you're a partner at an engineering firm that's not an SSTB, with no wages but guaranteed payments, provides no benefit. The answer is, if the taxable income of that person who's a partner filing a tax return is greater than $415,000, then they will have qualified business income from the engineering firm that would apply, but you have to compare that deduction, which is 20% of the QBI, times 50% of the wages that are allocated to you. And if wages allocated to you are zero, then you would not be entitled to a QBI deduction at all. That's where you would want to consider some of what Scott mentioned earlier about, does it make sense to have some wages in that company so that your QBI deduction is not lost?
For example, if you use some contract labor now, maybe that's a person to add part-time and have them be wages, pay wages to them, or, but yes, you would need, you are correct, if your income is high and there's no wages paid through the business, then that would limit your deduction perhaps to zero.
And one other thing, when you mentioned that there's no wages but guaranteed payments, if in fact everything that you earn from the engineering firm is all guaranteed payments and you don't have any ordinary income, then you don't have any qualified business income to start with, because guaranteed payments are not considered qualified business income deduction. So you would not get a deduction to start with anyway.
So certainly if there's more conversation needed, please reach out to us. I believe that's all the time we have for it. Is that correct, Kayla? Then thank you again, and we look forward to talking to you all as we can be of more help.